Hello. Thank you for stopping by. If you're visiting my channel for the first time, my name is Michelle D'Souza. I'm a licensed financial advisor in Ontario. Today I'm going to talk about a pretty interesting topic. What happens to your investments if you leave Canada? Canada. Now, based on the feedback that I received on my previous videos, it seems to me that many people are interested to know what happens to all their investments, be it real estate, be it all the registered investments or non-registered investments once they leave the country. So I'll go over this topic in a bit of detail in this video today. But before I delve into this, I want to give a clear disclaimer that I'm not a chartered accountant nor a tax expert. So please do talk to your own tax accountant or someone who handles your corporation or individual accounts to understand details pertaining to your specific scenario. Before we go into what happens if you leave Canada, we need to understand a few things. First things first, there are two things you can do with a country, right? You either immigrate to a country or you emigrate from a country. So when you immigrate or when you emigrate, the year you do that, your tax situation is slightly tricky and needs further analysis. So when it comes to Canada, if you are a resident in Canada, you are taxed on your worldwide income. Now, this term resident is important to understand. Resident in plain English means a very simple thing, right? If you live in Canada, you are a resident of Canada. But when it comes to taxation purposes, be it during immigration or emigration, resident actually takes a very different meaning. So Canada taxes its residents on their worldwide income and it taxes its non-residents on their income earned through Canadian sources. So this is one thing. Whereas US imposes taxes on its citizens as well as residents. Thankfully, that's not the case with Canada. Now let's understand what a resident means for tax purposes. There are actually two types of residents. The first one is a factual resident and the second one is a deemed resident. Now, the year that you immigrate or emigrate, a factual resident, the way you analyze who constitutes a factual resident is through certain ties that that person has with Canada. So there are three types of ties. First one is called significant ties. The second one is called secondary ties. And the third one are some other tertiary ties. Okay, the main ones are the significant ties. I'll put here all the significant ties that will make you a factual resident. So the first one is if you have a permanent dwelling space, a primary residence in Canada, you become a resident without any question. The second one is if your spouse or your dependents are living in Canada and you are in another country, then also you're considered a factual resident. So when it comes to significant ties, there are no questions asked, no further analysis done. You are a resident of Canada, even if you're not physically present in Canada. The different types of secondary ties are here. So the first one is basically the investments that you have in the country. It could be your RRSPs, TFSAs, RESPs, RIFs, LIRAs, all the investments under your registered, non-registered account. It could be your driver's license, OHIP, even your car registrations. It could be any kind of social ties that you have. You could be member of some clubs like Toastmasters Club or some kind of religious fraternities, then also it's considered a secondary tie. If you have a brokerage account, it could be, in recent times, we have Wealth Simple, Questrate. If you have an account in these, then those are also called secondary ties. If you have a post box to your name, that would be a tertiary tie. If you have any kind of furniture, clothes, storage, anything that you have kept in storage over here, any personal items, those are also called tertiary ties. Now, when it comes to secondary and tertiary ties, things become a little more hazy. CRA has to be convinced that you do not plan to come back to Canada because of your secondary ties. Now, if people are running a business from Canada and they're located elsewhere, then the CRA would assume that you always wanted to come back to Canada, so your ties are strong enough, and then they would consider you resident for taxation purposes. So these kind of details have to be chalked out with your tax expert before you leave the country. You make sure you sever all these ties so that you wouldn't get a big tax bill at the end of the year. So this was all about factual residents. And then we have something called the deemed residents. Now here the equation is very simple. If you have spent more than 182 days in Canada, even if you're coming for a vacation, even if you just come here, stay here and do nothing for more than 182 days, you're considered a deemed resident of Canada. We just walked through how you can be classified as a resident of Canada for tax purposes versus a non-resident of Canada. So now let's come to the second step. Say you become a non-resident of Canada in the year that you're emigrating by taking care of all the significant ties and making sure, talking to your tax accountant and reducing your secondary ties to a minimal amount. So in this scenario, you become a non-resident of Canada for, say, a particular taxation year. Now, in that same year, you become a resident of another country where you're supposed to pay taxes. Now, I'm from India, so I'm just going to do a comparison with India. If there is a tax treaty between the two countries where you're immigrating and emigrating from, then you should consider yourself lucky, because in that way you can avoid dual taxation. Now let's just consider the example of India and Canada. India and Canada have a tax treaty. As of today, as of the date we speak, there are about 96 countries with which Canada has a tax treaty. Say due to whatever reason you were emigrating back to India, and that year you could not cut off all your significant ties and you ended up remaining a resident of Canada. And the same year, you became a resident of India as well. You associated significant ties in India and you started earning an income in India. In that case, Canada will charge you income tax on your worldwide income as a resident. So, whatever income that you're making in India will be used by the CRA to tax in Canada, and the same income will be used by India, the income tax department, to charges income taxes in India as well. So you're going to pay like a significant chunk in India and another significant chunk in Canada, and that will be paying taxes for the same income two times in two different countries. How the tax treaty helps here is there is a way, again, this is something that your tax accountant can help you with. One country where you're actually a resident will take the majority of the taxes, and the other country takes a difference of the taxes that you owe between Canada and India. Like, which country gets the majority of the taxes versus which country gets a portion or the difference amount is something that your tax consultant can help you with. Now let's come to the investments or what you need to take care of if you're leaving Canada. First things first, talk to your accountant, make sure that you can sever all the significant ties before you leave Canada. It's best because you wouldn't want to come back to Canada just to maybe close a simple investment account, right? That's not even feasible. What are the major investments that we do when we are in this country? The first thing, real estate. So, what happens to real estate when you leave Canada? You need to first make sure that this real estate is, or the house that you own, is no longer your primary residence. And you can rent it out to a third party, but if that residence, or if you have only one house in Canada which is considered as your primary residence, then that will be a significant tie and you will be considered a resident in Canada for taxation, and you wouldn't want that. So you can actually rent it out to any kind of third parties, and but then again you have to take care of the rental income that you can get. That's a different topic altogether. But I'm just going to concentrate on the year that you're leaving Canada. Okay. So that year, say you have the primary residence, you've converted it into a secondary residence, and you've rented it out. Now, the other thing that, if say you have some investment properties or a cottage that you have invested in while you were in Canada, in that case, your real estate can continue to be there. I mean, you need not dispose of that property when you're leaving, but make sure that any kind of sales that you need to do in real estate will be considered a disposition, but it'll be basically your Canadian income source, and there would be taxes withheld as well when you do a sale. In fact, what I read is 25% of your property proceeds, complete sale value, not even just the capital gains, right? Complete sale value is actually withheld by the CRA. So if you want to avoid that, make sure you have a notification to the CRA that you're only selling one property and that's your only income. And in that case, they'll only withheld 25% of the capital gains. In fact, your tax liability may be even lesser than that. So these kind of things you need to take care of with real estate if you're leaving, right? And in later years as well, if you're selling that property or if you're giving it for rent, you have to be careful of the income that you're making in Canada with that property. Now let's talk about some of the tax deferred registered investment vehicles that we have in Canada, the RRSP, RIF, LIRA, RESP. Now, mainly RRSP, we get contribution rooms every year, and I still haven't touched upon LIRA and RESP, which I will make few more videos talking about these, but let's concentrate on RRSP. So RRSP, if you have invested it till the time that you are in Canada, it is continuously growing tax-free, and it will be tax deferred. It will be taxed whenever you withdraw that money. So the year that you're leaving Canada, if you want to liquidate all those assets, then that year it will be added to your gross income. If you do not want to liquidate the assets, that's also okay. It can continue growing tax-free, and you can actually talk to your accountant to make sure how you can take that money year by year in a way that can give you the least tax bill if you're outside Canada. You also need to see how the other country takes it. So one thing to note is any kind of retirement accounts generally are not rolled over to another country's retirement accounts. So it wouldn't be an easy rollover either. So it's just an account that Canada will help you grow your money tax-free on. Now let's come to TFSA. TFSA is an amazing vehicle. I love this registered umbrella because there are no more tax liabilities associated with this one. So you can remove the money anytime from this account, at least from the Canadian point of view. The government, the CRA doesn't tax you, but it could be taxed in other countries, and that is something again you need to discuss with your accountant. One thing that you should note is if you are a non-resident, you do not get any more room in TFSA, and you can't contribute either in this account. Even if you have room, say from previous years, you cannot contribute as a non-resident. But you can retain that money The time you become a resident of Canada, you can of course remove the money and you can retain whatever you have invested. And when you come back to Canada, again, you can start gaining the contribution room and start reinvesting in TFSA. The last thing is the non-registered investments, any kind of brokerage accounts that you have, any kind of dividends that you can get. All of these, on the date that you leave Canada, they are deemed to be disposed of. Now, what does deemed disposition mean? Deemed disposition is basically the assumption of selling your assets at the fair market value as of that day. Now, fair market value is the price that that particular investment has on the day that you leave Canada, minus the adjusted cost basis of the investment when you first did it. So, say for example, you invested in 2014, January 1st, 2014. The value of the stock was, say, $10, and you left Canada in January 1st, 2022. The value of the stock was $50. So your capital gains as of January 1st, 2022 were $40, and that $40 will become your income in the year that you leave Canada. But then note that these investments can continue growing. It's not that you're actually selling that particular stock. They can continue growing, or they can even have losses, whatever that is, right? But you can continue to keep the investments, but any kind of non-registered investments are deemed to be disposed of and taxed in the year that you leave Canada. But then again, you should also be careful about what happens in the country that you're going to become a resident, because that country may not take the fair market value of the date you landed there. Instead, they may consider the date that you actually bought the stock on, which is in 2014, and that would become a double taxation for you. And this is a specific case again that you need to talk to your accountant about. So we touched upon all sorts of investments that we can have in Canada, and there are like very much intricacies with respect to different kind of real estate investments, registered investments, non-registered investments. And then again, if you have a business in Canada and if you have an incorporation, then the rules are a lot more, which again I haven't gone through in this video. So I hope you found this content useful. Just make sure that you are in constant touch with your accountant, you understand these rules for your own investments. Though you're talking to an accountant, it's very necessary you have a good idea about what you're dealing with when it comes to leaving the country. So with this, I'm going to get to the end of the video. Thank you so much for watching till here, and I hope to see you all in the next video.